Hello, and welcome to the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland. Today's guests are the ADMIS Research Team of Mark Bowman, Mark Soderberg, and JP Steiner. Starting with the financial markets, JP, what were your takeaways from the Fed's rate cut and summary of economic projections?
Yeah, the Fed cut interest rates last week, to no surprise to anybody, and also updated its summary of economic projections. And in my opinion, also gave out some hawkish signals. Chair Powell said that the Fed is still in a meeting by meeting situation regarding the outlook for interest rates, and also characterized the rate cut as a risk management cut rather than the start of a new easing cycle. Powell also added that the Fed is well positioned to move on any economic developments, but that the committee felt cutting rates was appropriate given the downside risk to the labor market. Powell also noted that no risk-free path is available for the Fed. What also caught my eye was that 6 members of the Federal Open Markets Committee projected no more interest rate cuts by year end, while 1 member actually sees the central bank raising rates one time per the Fed's new updated dot plot. The SEP also showed that committee members see GDP growing 0.2% over the previous projection, while unemployment and inflation remain unchanged. To me, this signaled that the bank is tending to view tariff-induced inflation as more of a one-time pass-through and less of a persistent pressure, although those expectations will be put to the test on Friday with a new slate of PCE inflation data. The median dot plot value also showed that the committee is expected to show 2 more quarter-point reductions by year-end. Despite that, Powell's comments and lack of urgency in signaling more easing kind of has led me to be more cautious of expecting 2 more rate cuts from the Fed this year, although I still would expect them to cut rates once more. But given the lack of a commitment to a new easing cycle and his reiteration of a meeting by meeting basis, I got a very hawkish tone from his comments.
Hey, thanks, JP. What was notable about the Bank of England and Bank of Japan's meetings?
Yeah, the Bank of England and Japan both held rates steady at their latest meetings and also offered some important signals on what to possibly expect moving forward out of the central banks. Starting with England, the Bank of England left its key interest rate unchanged at 4% and also scaled back a program designed to shrink its holdings of government bonds that has attracted increased scrutiny as yields have risen due to fiscal worries in the country. 7 members of the Monetary Policy Committee voted to leave borrowing costs as they were, while 2 supported a rate cut. That has kind of sent signals that policymakers are growing more worried about a pickup in inflation. That's been driven by food price increases and a series of price increases that are also guided by government policy, including a 26% increase in water charges. Inflation in the country stands at 3.8%, having started 2025 at 3%. Policymakers estimate that inflation is close to its peak and do see it falling back to their target as wages slow in response to a cooling jobs market. But so far, inflation has been very sticky in the country and caused policymakers there to worry more so. In the Bank of Japan, they also left their interest rate steady at 0.5%, where it's been since January. The Bank of Japan is assessing U.S. tariffs and domestic political uncertainty. The central bank there said the economy is recovering moderately, but pointed to areas of weakness and warned that risks from global trade policies remain. Notably was that 2 policy board members dissented from Friday's decision to hold, signaling they believe the bank is ready for another rate increase. Those votes have shifted investor focus back to how soon the Bank of Japan will hike rates. Some analysts are expecting the bank to have its best chance at hiking rates at its October meeting, but markets remain unsure whether or not the bank's policy path will be affected by the October 4th leadership race to replace the outgoing prime minister. Bank of Japan Governor Kazuo Ueda said that the bank will be looking at how much downside risks from U.S. tariffs will affect the Japanese economy and prices in regards to when the bank may hike rates again. Looking ahead, inflation data due Friday is expected to show that consumer inflation, excluding fresh food prices in the Tokyo metropolitan area, have risen 2.8% in September from a year ahead. A strong reading here could bolster expectations that underlying price pressures remain sticky and also add to expectations of a rate hike this year.
All right, thanks, JP. Moving over to the grains, Mark Soderberg. Why the broad-based weakness across the ag space to start the week?
Well, I think it's a combination of things, not just one or two items that we can point to. The ag markets, particularly soybeans, are disappointed that President Trump's talk with Chinese President Yi last Friday did not yield an immediate time frame for establishing a trade deal that would involve the U.S. Sale of soybeans to China. It has, as has been discussed here frequently, really over the last several months, China has yet to buy any U.S. soybeans for the 25-26 marketing year. As of late last week, U.S. FOB prices for soybeans were roughly $40 a ton, below that from what's being offered from Brazil. But when you tack on the 23% tariff into China, it's roughly $50 over Brazilian soybeans. So would not expect any sales anytime soon. Well, President Trump and Yi have agreed to meet face-to-face in late October at the APEC summit in South Korea. Just the window for an opportunity of U.S. soybean sales to China ahead of the Brazilian harvest, that's becoming increasingly tight. U.S. sales to other countries not named China are starting to pick up. However, we have a long way to go to make up that lost demand. Right now, U.S. soybean exports, they're off 36% for the new crop commitments. The USDA forecast is only a 10% reduction. And then you look here in the U.S., harvest just really getting underway. While crop conditions have pulled back on late season dryness, I'd still expect to see record yields for both corn and soybeans. Weather in South America is also favorable. We're starting to see some pretty timely rains across Argentina and southern Brazil. Rains are forecast start filling in across west central areas of Brazil as they transition into their monsoonal season here in October. Bean plantings just underway at 1% complete. Their first corn crop there, 25% planted. And when you look at bean oil down another full penny today, to me, it just seems the market's losing confidence that the EPA will be able to reallocate any of these small refinery exemptions onto big oil companies as they sift through this 45-day window seeking public comment. Speculative traders have been kind of jostling around back and forth in the soybean market along a little bit as of the last CFTC report, but was selling late last week. And again, this morning, I think you're starting to pile up a little bit here on the short side of the bean market.
All right, what are your expectations for this afternoon's crop progress and conditions report?
Well, since peaking in early to middle part of July, both corn and soybean ratings, they've been on the decline as they seasonally do. So with that in mind, I'd look for another 1% drop for both corn and beans. That would take corn down to 66%, good to excellent, 62% in the soybeans. I think we had some decent harvest progress in the eastern corn belt last week ahead of the rains this week. I look for corn harvest to come in around 12%, keeping pace with the historical average there. I look for bean plantings to have reached 11%. Wet conditions across the central and southern plains last week likely held the winter wheat plantings in check. I look for that to come in around 21 to 22%, behind the historical average of about 25%.
Thanks, Mark. What is next for the coffee market?
All right. So we had a key reversal action from a technical standpoint on the weekly nearby chart last week, which does suggest a potential technical top is in. On top of that, and it also suggests maybe finally that this whole idea of the Brazilian tariffs has played itself out for this market. The couple things have happened. We've got a couple of representatives in the U.S. House of Representatives planning to introduce bipartisan legislation that would exempt coffee products from any tariffs imposed after January 19th. Now, this still has to pass and still has to survive a veto, but does highlight maybe the frustration with the extreme tariff on a favorite beverage for consumers in the U.S. that is not grown in the U.S. On top of that, we have these cases against the tariffs that are expected to make their way to the Supreme Court in November. May not have a decision until January, though. But still in all, this might maybe the bullish news on this tariff thing may have finally peaked. We have seen a huge draw in ICE exchange stocks, coming down from over 892,000 in May to 654,000 on Friday, as U.S. Buyers were looking to find stocks anywhere they could. This has also, though, possibly brought a reluctance on the part of Brazilian growers to sell their new crop when all this is up in the air. And so for that reason, I'm not sure that this is anything going to be more than a technical move until that all gets straightened out. Still in all, it seems like a top may be in.
All right, Mark, final question. How is the demand situation for natural gas?
So we've got a warm weather trend across the entire U.S. Its latest 6 to 10 and 8 to 14-day forecast has really the entire lower 48 states expecting above normal temperatures out through October 5th. That could bring some late season cooling demand, but it also limits heating demand, which on balance could lead to more above normal gains in U.S. supply. We use more natural gas to heat our homes than we do to provide electricity to cool our homes. And so now we're in this like shoulder season, but it seems like the demand situation could be slower than normal. At most of the summer, U.S. supply injections have repeatedly come in above average for the time of year. And as of last week's report, U.S. storage was only down 0.5% from a year ago after being 27% lower in March, and it was 5.9% above the 5-year average after being 12% lower in March. So the oversupply is kind of palpable.
All right, thank you all. Remember, the views and opinions expressed today on this video are solely those of our guest speakers and should not be construed as the views or opinions of ADM Investor Services, or ADM. If you would like more information about our brokerage services, please visit admis.com. Thank you.